And right on cue, guys, Janet Yellen has spoken. Last week, she wrote a letter to Congress warning that the government was running out of money, according to several articles that I've been finding online. So, if you remember, about a couple videos ago, I gave you a kind of, forward-looking projection that to watch out for when Janet Yellen starts speaking to Congress and saying that the U.S. Treasury was running out of money, to signal when we might see a downward turn in stocks, as well as a potential upward pressure in precious metals and possibly Bitcoin. And the reason why is not because the economy is actually at stake here. It would be if Congress were to move past the debt ceiling without a resolution, and then it would be potentially disastrous because at the current spending levels, the United States might actually have to default on some of its debt. But in reality, it was more like investors placing their bets and hedges and uncertainties from this. In any case, she's warned that after we reached our $22 trillion debt limit to the public, that if there's an agreement to raise the debt ceiling, the Treasury would have to employ, quote, certain extraordinary measures, unquote, so that the government could continue to fund itself, okay? So then once all available measures and cash on hand are fully exhausted, according to Yellen, the United States of America would be unable to meet its debt obligations for the first time in our history. So according to Yellen, they can't give you an exact date, which is probably true, of how long these so-called extraordinary measures would last. But she's saying that the money would completely run out in the middle of October. Now, if you've listened to me, I said that this would become an issue by the end of September. It looks like I was a little early. The reason why I was gauging that is that I was just taking a look at the drawdown of the General Treasury account that has been going on ever since. Well, it's really been ever since we have had the turn of the year, but that was after we had an increase in account money from all the federal borrowing and stimulus in the early stages of the pandemic. Now, the Treasury account has drawn down to a critical $200 billion level as of the reading on September 8th. And we haven't really been that low since the repo market crisis in 2019. So if you remember back in 2018, 2019, the Federal Reserve was trying to sell off assets at the Fed and suck out some of that excess liquidity in the markets in order to normalize interest rates. Of course, at this point in time, about, say, the beginning of 2019, they started to engage in a policy of lowering short-term rates, but they were still more or less selling those long-term treasuries. In any case, it got hit at the General Treasury account back in late August before they got a boost in funds from quarterly tax payments. But then that resulted in a repo crisis as banks all of a sudden found themselves suddenly short of liquidity faced with too much collateral. Well, the General Treasury account is just running out of money again. They're burning money. So in the last month, they've burned $300 billion. Okay, so since August 11th, right, or really August 4th, they've burned $300 billion. So I was just going based off of that math that says, well, if it's September 8th and it took them a month to burn $300 billion off of $500 billion and all they've got left is $200 billion, then maybe they'll last another 2/3 of a month, and that would put us at the end of September. But Yellen says that we can go into the middle of October because she's going to engage in extraordinary measures. Now, what are these extraordinary measures? Well, some of them involve suspending the funding of investment plans for things such as the thrift savings account. That's something that's funded for U.S. military members. She can do the suspension of issuing new debt securities for the Civil Service Retirement and Disability Fund, as well as the Postal Service retiree health benefits. Okay, so what does this mean? That this means that there are certain special debt instruments that are issued by the government, IOUs, aka most likely Treasury bonds of some sort, that are used to where these retirement funds are deposited into, but they basically just purchase that debt off the market. Well, now that's going to be suspended, and that suspension of funding will help keep the debt ceiling intact, because otherwise what she would have to do is issue that new debt against that hard debt ceiling of 22 trillion. And what she wants to do is keep us under that 22 trillion of new debt as much as possible until she has to raise that to that limit. But we're already at that limit now. So she's basically trying to keep us at that limit and not go above. Otherwise, we're in trouble. And then then there's the last part about this that I did not know about, but there's this thing called federal financing bank securities. So there's another set of bank securities debt which can be exchanged for Treasury securities that is held by this CSRDF, the Civil Service Retirement and Disability Fund. So there's another set of debt instruments out there that she can basically swap in for Treasury securities, okay? And by swapping in for Treasury securities, she can temporarily fund these retirement funds without having to issue new government debt. And it's basically just measures that can be taken to hold off issuance of new debt until that could fund the general Treasury account until Congress agrees to raise the debt ceiling here. So that's basically it. At the end of the day, though, the government has to spend, and on a monthly basis, our federal government is spending about $400 billion at a minimum, because the normal general Treasury, the normal budget was $5 trillion before going into COVID. Now, it's obviously gone above that, but Congress has not agreed to an absolute new budget yet. That's what the whole argument is about over adding in this $3.5 trillion of spending here over the course of 10 years, is how much do we increase the next federal budget. So because of that, we're really burning about $400 billion, but then we're taking in a certain amount of tax revenue. And then, of course, as I mentioned in my previous video, this is time for quarterly tax payments, so that might help keep them elevated and afloat for some time and possibly past September 30th. But I really was thinking that by September 30th, we would be in trouble. Either way, regardless of whether it is the middle of October or the end of September, we're going to be seeing this issue. Now, as of today, we have not seen that jump yet in the price of gold and silver, okay? So we're not seeing this jump yet. My opinion is that we should start seeing the push upward very, very shortly from this. And again, it will probably be in the last 2 weeks. So if she's right that we're not going to see this until the middle of October, then I may have been early on the call for the temporary switch, in which case we might see a dip in stocks and a rise in gold. But I still anticipate that to happen. Now, as for the stocks, they're on a downward trend. So ever since August 16th, for the past month, they're pretty much been on a downward trend. Now, the Dow Jones did go up yesterday for a substantial amounts. It climbed by almost 1%, but when we compare it to where it was off of its August high, it's still down by a couple of percentage points. So it peaked at 35,625 on August 16th, and it is now more than 2% below that still as of September 13th. Now, that doesn't mean that it's just going to continue downward here, because, as I said, there's not really much downward pressure. The key thing to keep in mind here is, I'm making this early in the morning today, is that we're going to get those consumer price inflation numbers out. If they're as bad as I say that they are, this could result in a downward turn in the stock market as investors become increasingly concerned about inflation eating away at real economic growth, as well as killing corporate profits, especially on the producer level. Now, while it might enhance profits on a retail level, if it's being driven by higher producer prices and the consumer prices are not rising up to meet those inputs, and yet they're having to be marked up in order for businesses to preserve or help keep up gross margins, then that's when it's going to become trouble and could spell doom for stocks. And in the meantime, it would signal that inflation is here and longer to stay than what we've been told by federal officials, and it could potentially be bullish for gold and silver. So we could see an upward trend today at least, or at least in the next few days, of gold and silver and a push down in stocks before things sort of normalize again, and then we get into this like debt ceiling debate debacle. It's really going to depend on how bad those consumer price inflation numbers are going to be. Like I said before, based off my own analysis, looks like we're going to be seeing it at about 1% month over month. Could be a little bit more than that, although I don't really think so. I think 1% is really high on the call anyway. But in my opinion, if we see 1% this month for August's numbers, and then get 1% next month for September's numbers, that's going to be two back-to-back bad months. And not only that, we're then going to be in the middle of the debt ceiling debacle. So the middle of October could be a perfect storm for a jump up in the precious metals bids, certain commodities. Oil could be another factor that could drive up in that manner, as well as a downward push in the stock market. So guys, keep on the lookout for that. It does not mean that this is going to be a temporary shift yet. This is not going to be a signal that the economy is falling apart as we would normally see it, like it would be from a burst in an asset bubble, such as what we saw in 2008 or 2001. It could be more akin to something that we've seen in the 1970s, where we see things more on a volatile nature. But if we do get into a 1970 scenario, not saying that we will yet, it's too early to make that call, but if we do get into that kind of scenario, it's definitely going to be bullish for precious metals, bearish for stocks on a real return basis. Yes, true, stocks could appreciate on a nominal basis, but once adjusted for inflation, the returns will most definitely be negative. Guys, thank you for watching this video. I'm going to post another one this evening about the consumer price inflation reports, give you an update as to what's going on there, kind of do a little bit of a breakdown, then doing an analysis and a projection, a comparison to how it's functioning with my final demand consumer price index model, see what next month is going to tell us, and give you sort of some economic insights into that. Guys, make sure you click like on the channel. Or click like on this video, subscribe to my channel if you haven't already, leave a comment, and click that notification bell as always. And until then, I'll talk to you next time.